Hello, everyone. Thank you for joining us. We are so happy that you are here for this mid-year financial checkup webinar with one of our certified financial planners and CPA, Joey Bailey.
We'll go over a lot of things that if you're doing them at the middle of this year, you're going to be a lot more prepared for the amount of dollars that you're able to spend at Christmas. So that's my promise to you. If you go through these mid-year financial checkups, you'll be a lot more prepared for the financial journey that you have ahead of you. We're going to talk about, is your portfolio on track? What does that mean? Is your portfolio on track? That doesn't just mean, is it growing, right? Is it on track for your budget? Is it meeting your budget needs? Is it on track for your short-term and your long-term goals? Are you meeting all of the tax strategies that your portfolio is supposed to be meeting for you? Right? Is your portfolio going to be impacted by any debt or any emergencies that may happen? Are you on track for your retirement planning, your retirement accounts, your retirement investments? And is your portfolio on track to do the things that you want it to do when you're gone? Your estate plan, right? For your gifts, for your kids, the things that you want to do with your estate. So let's start with examining your budget, right? I think this is important. 45% of people plan to focus on long-term savings goals, right? That means that not even half of the people out there are planning for any long-term savings goals, right? It's an afterthought to them. 55% more people are focusing on short-term goals, right? But still only 55%, only half of the people out there are focusing on some sort of short-term or long-term savings goals, right? So how do you focus on some of your goals? Well, you got to examine your budget, right? You've got to take a look at the dollars that are coming into your bank account, the dollars that are going out of your bank account. You've got to determine what are all of your external sources of income, right? Is it a salary, a pension? Right? If you're retired, it's Social Security, it's a pension. If you're working, it's a W-2 income. It's your wages that you might be paying yourself if you're a business owner. Rentals, if you have rental properties, right? All of the different sources of income that you have. And then, of course, there's outflows, right? The second that you make money, you're sending some of it to taxes. You're sending some of it to your retirement accounts, right? You're sending some of it to your mortgage payments or your rent. You've got food, utilities, gifts, entertainment, right? There's a lot of things that this money is going out to. So evaluate all of that, right? Get your hands around all of that, right? Once you have your hands around all of that, you can check in. Are you meeting your monthly goals? Do you have monthly goals, right? And so how do you wrap your hands around some of that? That's the task, right? If you have multiple bank accounts, you may have dollars going into many bank accounts. You may have multiple credit cards, right? Dollars going out of different debit accounts, different credit accounts. If you're married, maybe the husband has his own account, the wife has her own account. Maybe it's combined, right? But corralling all of these sources is really important so that way you can start evaluating and examining your budget really in detail. And it doesn't have to be complex, right? Creating a budget could be relatively simple. It's your income, right? Think of an income statement. Revenue minus expenses equals net income. Income comes into your bank account. Let's say it's $8,000 a month. Be cautious with this, though. You might make $120,000 a year of wages. That's $10,000 a month, but maybe only $7,000 or $8,000 shows up in your bank account. Why? Right? Well, because federal tax, state tax, contributions to your retirement accounts, right? There's a lot of things that get withheld. So what income comes into your bank account? What is that dollar figure? And then from there, what are some of the outflows? How much are you saving, right? Beyond your retirement plan contributions, if any. What are the things that you need, right? We know the things that we need. The roof over our head, the food in our stomachs, right? Utilities to be paid. There's things that we need to spend money on every single month for as long as we're alive. What does that cost you, right? And there's things that we want. Nicer cars, bigger houses, fancier restaurants, nicer vacations, you name it. We all have different wants, right? We all have a lot of similar needs. But what is the cost of your wants and needs, right? And is there any left after you have that income and you have those expenses, right? What is your budget look like? What does it look like now? What will it look like going forward? Keep it simple. Check on your emergency fund, right? This is always paramount. Every several months, you want to be dialing up how much cash you have on hand, right? What is your emergency fund? You should know, you should take that budget, figure out how much it costs for your monthly expenses. If it's 10,000 bucks, general rule of thumb is you should have 3 to 6 months of emergency funds on hand, right? So if you're spending 10 grand, have 30 to $60,000 set away for emergencies. If you're spending less, you should save less. If you're spending more, you should save a little bit more. That's a general rule of thumb. Some people would feel very uncomfortable with only 3 to 6 months. Maybe your comfort number is a year of cash, right? What is your comfort number? At least 3 to 6 months of emergency funds. Your emergency funds aren't for things like your entertainment and your travel and all of the wants. It's for the needs. It's for the rent, the mortgage, utilities, food, transportation, the needs of the budget, right? So remember that as you create your budget, what are the things that you need versus what are the things that you want? 55% of US adults had 3 months emergency savings in 2024, right? So half of US adults have 3 months saved up. Debt, review your debt, manage your debt. Can't say this enough. It could creep up on us. Find all of your different sources of debt: automobiles, credit cards, personal loans, small business loans, student loans. Corral your arms around all of it. Figure out how much you pay for each one each month. Figure out the interest rate. Figure out what that's going to cost you over the course of a year. Figure out when does that debt mature and how long is it going to take for you to pay it off. Okay? If you have multiple sources of debt, you might want to consolidate it. If you have a lot of different credit cards, does it make sense to consolidate it into one? Can you take one personal loan at a lower interest rate than some of your higher interest rate debt? Find your debt with the highest interest rates and start tackling it, right? Carve out a portion of your budget each month to tackle that high interest debt, right? Make sure that you're tackling your debt. Don't let it get out of control. We're going to talk a little bit about student loans in this later, but that's one I want to make sure people are focusing on, as the last number of years, I think people neglected to pay a lot of the student loans, and now there's some guidance that they will not be forgiven. And so rewrap your arms around those if you've kind of been neglecting your student loan debt for the last year or so. Long-term goals, short-term goals, these change all the time, right? Inspect what they are. Everyone's got a little bit of a different short-term goal and a different long-term goal, right? But short-term goals could be like paying down that debt, paying off that credit card statement, doing some travel, spending some of the money that you're making to have a little bit of fun. Longer-term goals, right? Retirement, what's that cost? How much do you have to save to get there? How long is it going to take you to pay off your house? Do you want to do that before you retire or after you retire? College education, family goals, estate goals, things are going to, be 1, 5, 10, 15 years out. What are they? Identify them, track them, right? And then make sure that you look back at them in a year or so, because they will have changed. Maybe you've accomplished that one, set a new one, right? That's the whole point of a goal, is that they're always out there. We accomplish them, we set new ones. So short-term goals now, in 6 months or a year, you should have been able to track your progress against them. Long-term goals, you want to be tracking and measuring your progress against them. How much is your net worth increasing? How much is your portfolio increasing? How much are your expenses increasing or decreasing? Right? Making sure that you're monitoring and tracking your progress towards your goals is going to give you a lot of peace of mind and clarity. It's going to give you a lot of focus. 74% of people say they have a monthly budget. I don't know if I always believe some of these stats. 83% say that they overspend. I think that that's probably, I see that pretty often, right? People overspend. They think they may be spending less. Once you dig into their situation, there's a lot of one-offs. Oh, my normal lifestyle is $100,000. But yeah, but the roof blows off. The tires need to get replaced on the car. The daughter needs some help. The dog needs to go to the vet. So yeah, your typical lifestyle might be 100 grand, but then all of these one-offs that we can't control are another 30 or 40 grand. Like, guess what? Those one-offs are going to keep happening. They're just going to look a little bit differently, right? So reassess your cash flows. This is super important, right? Reassessing your cash flows. When I say cash flows, I mean the dollars that are coming into you and the dollars that are going away from you. Income, your Social Security, is any annuities, brokerage accounts, 401ks, pensions, Your spending on your housing, your taxes, your groceries, dining out, vacations, right? All of those outflows, just reassess all of that. How do you do that? Well, after you've corralled your arms around all of that different credit cards, checking accounts, debit accounts, whatever it may be, look back 3, 4 months, right? You'll be able to see line items for food, for gas, for entertainment, for your mortgage payment. You'll be able to see what your spending is, right? You're going to have things that maybe you want to do more, maybe things you want to do less. I oftentimes tell people if they find joy in the things that they're spending, keep doing it. If they don't, get rid of it. Right? See where you can save. If savings is a requirement, right? When you add it all up and you're like, I gotta save, see where you can. There's going to be areas where you can't save. You might not be able to save on your rent or your mortgage payment, but maybe you can. Maybe you can downsize. Maybe you could live a cheaper, more affordable lifestyle, right? Insurance is expensive. Have you looked at different insurance options? Or do you have multiple cars or multiple assets that are costing you money, right? They're nice to have, but they cost you money. Do you need them? Relocation's a big thing. A lot of people are relocating to different cities, to different states, right? Lower cost of living, bigger houses, smaller houses, whatever it is that their lifestyle demands. Luxury items, they get a lot of people, boats, cars, they're expensive. They're expensive, right? Make sure you can afford them. Home remodeling, supporting adult kids, right? What's more important to you? Ensuring your retirement is taken care of or making sure that your 30 or 40-year-old kids are a little bit more comfortable, right? If you can afford to do it, great, but this is an area where I oftentimes see a lot of my retired clients sacrificing a lot of their retirement for the betterment of their kids. If you can afford to do it, great. If you can't, you've got to get things under control. Second homes, third homes, these things get expensive. It's great if you could afford them. It's great if you could do them, but just think twice about it. Make sure that you've got all of the numbers lined up. How much is this going to cost you? Can you afford it? Review your portfolio. Take a look at it holistically, okay? I recommend having your investments in your portfolio in one location, in one firm, or at least in one area, one brokerage account where you can see and monitor all of your accounts, right? It's difficult to log into 15 IRAs and brokerage accounts and 401ks and monitor all of your investments. It's just a challenge. You got passwords, you got to reset them, you got to get new emails, right? You want to go in and spend 5 minutes to rebalance your portfolio, but it's complex when you have assets spread out across 15 different accounts, right? So monitor things in one place. Keep your administrative fees in the portfolio as low as possible. You have internal expense ratios. You have administrative fees. Annuities have mortality and expense ratios. There's rider fees, right? Having things in one area helps prepare for your taxes more simply. Like how many 1099s do you want to get? You know, each account gets a different tax form. I think most importantly, having things in one area and having a holistic view is all about the distribution. At the end of the day, you create your portfolio so you can distribute that money back to you, so you can spend it, right? How do you do that when it's all over the place? Which account do you pick to take money out of, right? Which position do you sell? These are big decisions when you look at your distribution of your funds, right? The strategy that you use to distribute the funds to you. Make sure that your asset allocation is appropriate, right? Is your portfolio targeting a return on investment that you must achieve to accomplish your financial goals? Are you taking more risk than that? Are you taking less risk than that? What is your asset allocation? Take a look at all of your accounts. If there's multiple ones, you're going to have to put them all together to figure this out. What's the amount of stocks and bonds, the amount of cash, commodities that are in that portfolio, alternative investments that are in that portfolio? Okay? Dividing investment capital among 3 primary investment asset classes like cash, fixed income, and equities is a great way to diversify. Okay? A goal of having an asset allocation strategy is to maximize your portfolio's return while minimizing its risk. Right? Designing an investment strategy that's meant to achieve a targeted return on investment without taking too much risk. If you don't know what your asset allocation is, it's going to be very hard to determine if that portfolio is going to get you to where it needs to get you to. Diversification, right? A well-diversified portfolio smooths out the roller coaster rides that the markets take us on. We just experienced a 20+% drop in the S&P 500 a couple of months back, right? Well, while that was happening in the United States, international markets actually did pretty good. Different regions are going to perform differently in different moments, right? So being globally diversified from a country perspective, and then being diversified from a stocks and bonds perspective is super important to managing the risk of the portfolio and keeping the volatility of the portfolio as low as possible. Okay? So spreading your assets out amongst different regions, amongst different sectors and industries. Stocks, you have different types of stocks. You have small stocks, large company stocks, medium company stocks. You have international stocks. You have real estate, right? Bonds, there's all sorts of bonds, US bonds, government bonds, corporate bonds, international bonds, right? What makeup of stocks and bonds do you need to have in your portfolio to achieve your goals? And then how do you create a diversified strategy to get you there? Retirement accounts. Take a look at your retirement accounts, okay? Your 401ks, your 403bs, all those ones with the 4 in front of them, your IRAs. If you're able to, if your cash flow permits, if your cash flow allows you, meaning you have more money coming in than you're spending, consider increasing the contributions to your retirement accounts. If you're above 50, you get a little catch up, right? So if you've hit 50 and you haven't increased your contributions, look at your catch ups. There's a new contribution rule that the IRS just passed or Congress just passed. If you're 60, 61, 62, or 63, I don't make these rules, but they put a few year window in where you get an additional $3,750 that you could put into your 401k, right? So if you're in that window from 60 to 63, make sure you're maxing those contributions if you're able to. There's other types of accounts that may be available to you through your employers. Your flexible spending account, that's an FSA. You have health savings accounts. FSAs, you could put about $5,000 into these accounts. You get a tax deduction on them. They could be used for things like adult daycare and child daycare. Now, HSAs, similar type of a program where you put money in, you get a tax deduction from it. You can invest the dollars. They grow tax-free. When you take them out for qualified medical expenses, you pay no taxes on it. Some of the greatest, most powerful accounts. All right, I use them all of the time. Got kids in daycare, that FSA is definitely a strategic move. College savings, 529 plans, those are a big one. Any dollars you put in grow tax-free so long as they're used for qualified education expenses. Take a look at what, if you have college goals for your kids or your grandkids, take a look at what that might cost you and then what you can reasonably expect to afford. Are they going to go to an in-state school versus an out-of-state? Are they going to the Ivy Leagues versus a community college? Right? We all know that there's different costs for education. Are there going to be grants or student loans that they access? If so, what's going to be the amount that you reasonably are going to have to come out of pocket to pay for? Student loans. Okay. For several years, we've heard of these possibly getting forgiven. I've seen this too many times with clients and prospective clients. They say, we're just not paying them because we think they may get forgiven. I heard it, I hear it, but there's now been some talk that that's not happening, right? So if you have been putting your student loans on the back burner, hoping that they may be getting forgiven, that might not happen. All right, so make sure that those are front and center. Those don't just go away. Now, there is still some programs out there. There's income verification limits that could help out a little bit, but make sure you're not neglecting your student loans. Taxes. So tidy up on your taxes. So you can't really determine your financial goals without understanding the taxes that you have ahead of you, right? This year plus into the future. So you want to make sure you understand those income sources and then how are they taxed? How's your Social Security tax? How's your wages taxed? Are you taking money from your brokerage account or your IRA or your Roth IRA? How are those dollars taxed, if at all? Right? You want to make sure you've got a good tax strategy so that way come April, there's no surprises. Oh, I owe 10 extra grand.
We have some questions. We've got a lot of questions, so I want to see if we can get to some of them because we're doing really well on time. So, first of all, some people say that it's not beneficial to pay off my home. Why? Why would I not want to pay off my home?
Yeah, it's a great question. There's a few ways to look at paying off your home. One, what's the interest rate on the note? Right? If the interest rate on the note is very low, we had very low interest rates for 15 or 20 years. So you are still seeing mortgage interest rates on some prior notes that are 2.5%, 3%, 3.5%. So the rationale between should I aggressively pay this off is can you get a higher return on your investment than that interest rate is charging you? Mathematically, if you can get a higher return on investment in your portfolio than the interest rate is charging you, it would make more sense to allocate those dollars to your portfolio rather than aggressively paying off low interest rate debt. You also, now this is specific to the individual, if they're itemizing their deductions, you get a slight tax benefit for the interest that you pay on your home mortgage. And so the effective rate that you're actually paying could be lower once you account for the tax benefits that you get.
And then
That's one of the thoughts, but there's also, I think, really important to note, like, how do you feel about debt? Right? If debt keeps you up at night and you can't stand the idea of being in debt, then maybe you pay off the house a little bit sooner. But if you're comfortable with the debt and you have other opportunities for your assets to earn a higher return than what your interest is paying, then it's something you're gonna have to decide if you want to do or not.
that's a very good answer. And then on the same note, does one need property insurance if their home is paid off?
You would want property insurance if your home is paid off.
Yeah, because if something happens to your home or it goes on, catches on fire, or yeah. Um, this is one. I feel the market is volatile. How do I project my investment returns, not knowing what this administration will do next? I feel like it's something new every day. Did you bring your crystal ball?
Yeah, no, it's a great question. And truth be told, there's this administration, there's going to be another one after that, another one after that, another one after that, right? I believe that time in the markets is a lot more important than timing the markets, right? Historically, we know how the markets have performed through different administrations, through different wars, through different crises, economic crises, social crises, and the markets have been resilient time and time again. There's a hiccup every now and then. We talk a lot about it here at Pure, but time and time again, the power of the capital markets perform. So I wouldn't worry about this administration. I wouldn't worry about any administration. I think the power of the capital markets are much more powerful than any administration.
Very nice. This one, I don't know if we can answer this, but my wife loves to overspend on Amazon goods. Been there, done that. We've been married 10 years and it's hard to get her to stop spending. How do I talk to her about budgeting, buying what she needs and not what she wants? I guess that would be what's your thought being a young married person? How do you approach the spouse? And I might have a different answer or another different because I'm an older married person. So go ahead.
Look, I did this early I've been married for about 10 years and I did this probably in the first year, monitoring the budget, very strict. It's one of the things that I do. And I noticed Amazon, Amazon, Amazon. I let it go for a few months. I printed out all the credit card statements. I put them right there in front of my love. And I said, Erin, we got to talk about this. I just want you to see it. And as soon as she saw the number and the volume of transactions, she was like, whoa, I didn't realize I was hitting buy now every 14 hours, right? It's only $5 or $10. I said, yeah, but it adds up, right? So I think one, addressing it might be, appropriate, but then also determine, like, does it really impact you, right? I mean, if you can afford it, is it an issue? Now, if it's an issue, an affordability issue, then you need to tackle it head on, right? But if it's just an annoyance to you, then that's just a conversation that you're gonna have to have with your wife.
And I would say communication is key in any relationship. And I would also say that, by discussing a budget, as you've already laid out very clearly, that if that's what she wants to spend her money or, her allocated budget of free money, like your own everybody gets to have fun money, I guess I would call it. But yeah, communication. That's very good in any relationship.
No, I mean, it's a great point, right? That budgeting should be teamwork between the husband and the wife. We are planning on spending X this month on Amazon or on entertainment, right? And then if you go above it, it's about being accountable. So I think that that's a great point, Catherine, just communication.
All right, this is a question that so someone's asking a non-Pure client, I would imagine, does Pure offer references, the name and contact for similar people that we can talk to? We do have that where if someone wants to speak to, we have some clients that have agreed. We don't, but do you have clients of your own that are willing to like speak to somebody,
Oh,
Joey?
you mean like references from our clients about our services and about our firm?
Correct.
Oh, I've got a handful of them. Be happy to send them to you.
Gotcha. This is in your opinion, what are the best states to retire in and stretch your retirement savings?
I mean, look, where are we talking from taxes? Are we talking from sunshine? Are we talking where the kids live? I mean, it really does get down to your own personal goals, right? There's 9. I think there's now a 10th state where there's no income taxes. For me, I'm a big fan of sunny San Diego, man. It's going to be hard for me to get out of this place no matter what. So I can't answer that. Yeah, West Virginia, I hear, is pretty fun. But yeah,
Yeah.
truly, I don't know what the best. That really depends on your own personal circumstances.
Okay, this is a shout out. I thought it was cute. One of our clients says, this is a comment, not a question. Almost everything he is telling us regarding what we should be doing and watching out for are all things we pay Pure Financial to take care of for us. We trust Pure to make sure we have all these bases covered. So thank you for that.
We do a free financial assessment where that would be something where I was on this page when the questions got started. So about tidying up your taxes, right? Making sure you understand where your income is coming from and how it's taxed, right? Like whether it's W-2, Social Security, K-1 income, or if it's coming from your retirement accounts, like how is that income ultimately taxed to you? Super, super important. Uh, Little things, I want to make sure that you're maintaining records of your tax deductible expenses. So if you own a business, any business expenses that could be deducted, that mortgage interest expense, making sure that you're deducting that on your Schedule A, your itemized deductions, if that's an opportunity for you. Just maintain good books and records over all of your, finances. Look at the accounts of the types of the accounts that are used to distribute that money. That is probably one of the most important things that we look at on a day-to-day basis. It comes down to tax diversification, right? There's 3 different areas where you could invest your money, and they're all treated a little bit differently, or frankly, a lot differently from a tax perspective, right? We've got a tax-free pool of money like Roth IRAs. We've got a taxable pool of money. These are capital assets, second homes, stocks and bonds held outside of retirement accounts. You've got tax deferred accounts. These are IRAs, 401ks, right? The difference is that these tax deferred accounts, you get a tax benefit when you put the dollars in, but when you take the dollars out, you're going to pay taxes, right? Capital assets, these typically have a 15% capital gains tax rate. That's if you held the asset for a year or more, right? You put in $100, it grows to 200, you pay 15% federal tax on that. Now, there's some other capital gains tax rates like net investment income tax if you make more than $200,000 if you're single, or $250,000 if you're married. That's a 3.8% tax. There's a 20% capital gains tax bracket, capital gains tax bracket once your income's up above about $500,000-$600,000. So being aware of like where your income is impacts the tax rates that you're going to pay. Right, this bottom right tax deferred bucket, you have like 7 different tax brackets, the 10% to the 37% tax bracket, right? If you make if you're married and you make $0 to $20,000, that's taxed at what, 10%. If you make from 20,000 to 100,000, that's taxed at 12%, and then you've got a 22, a 24. And it goes up to 37%. The amount of money that you make determines where you're at on these in the tax brackets, right? So if all of your money is coming out of this deferred tax bucket, you might be subjecting your portfolio to excessive taxes. So how do you create some tax diversification throughout your working career and then even in retirement? So that way you have a little bit more control over where you take the dollars that you need from, right? It reduces your overall taxes, keeps more dollars in your pocket. Estate planning considerations. Like, do you even have a estate plan in place, right? Start there. If so, has it been updated? When was it last updated? Typically want to take a look at these things every 3, 4, or 5 years or anytime there's a major life event, right? New kids, new grandkids, move houses, those sorts of things, move states, right? What's going to happen to my children if I pass away? How will they receive these assets? What's going to happen to my spouse if I pass away? Do I have a family member with special needs? Are there special needs trusts that may need to be established, right? Are there guardians that need to be in place, right? Ultimately, how do the assets go where I want them to go and when, right? It's not always passing assets off upon death. There could be assets that get passed during your life. Do you want to see the gift being made, right? Are you leaving anything for charity? If so, what tax opportunities are available? How can you maximize your charitable gift, right, through the tax code? 24% of Americans have a will. One in four, right, of adults. So the cost of not having an estate plan, right? You can say, hey, I'm not doing this, and that's fine. It's up to you. But the costs of not having an estate plan are the burden on the family, right? They've now got to determine how all of this gets situated when you pass, right? There's no clear directive. I want this person to have X and this person to have Y, right? There's just no clear directive. It keeps everybody guessing. That creates unnecessary taxes, some unnecessary expenses, unnecessary fees. The courts have to get involved, right? And ultimately, you may have some wishes that you wish were carried out, but they don't, right? So that's the real cost of dying without an estate plan in place, is that the things that you want to have happen may not actually happen. So how do you wrap your hands around all that, right? It's like, hey, I've got a lot of homework, just getting my budget together. Similar, right? You create an inventory of all of your assets, your home, your bank accounts, your investment accounts, right? Your cash accounts. Create an inventory of it all. Wrap your hands around it. Have it on a spreadsheet. Have it on a document, right? Come up with what the needs of the families are. How much does Sarah need? How much does John need? Right? This kid might be doing great and said he didn't want anything. What does your family need and want? Right? And then from there, you can start documenting what those directives should be, establish it in a will, right? Put the trust together. Now, a trust might not need to be put together. So I'm not just saying run out and get a trust, but you should be taking a look at your assets and asking the question, should these belong in a trust or not, right? Making sure your beneficiaries are listed appropriately on all your retirement accounts. But you want to establish some directives for your will, potentially a trust, your advanced health care, your medical, your financial power of attorney. What happens to you? Who makes the decisions if something happens to you and you don't die? You become incapacitated, right? Who makes the healthcare decisions? Who makes the financial decisions, right? And so having that in place is really just making sure that all of your goals and all of your wishes are going to be more likely to come to fruition. Questions. I know we went through that relatively fast pace. It's been about 40 minutes or so. Any questions out there?
Okay, we have a few, and I have added some things to your chat so you can see, for those of you who have been asking about, our services, if you're not already a client, I've given you some links that you can click on and we can give you more information. Okay, so we talked about the 529. Is there a formula to determine is there a formula to determine the amount of funds to convert to a Roth account and not impact my net worth?
There's planning that could be done to determine how much of a conversion should you do, if at all. I think the first step is determining whether or not a Roth conversion even makes sense, right? So that's step one. Like, do you even make a Roth conversion? If so, then it's how much and when. Are you targeting a certain tax bracket? Do you have cash to pay the tax? Right? So, I mean, yeah, there's a world that exists where I could come up with the most awesome Roth conversion strategy in the whole world, but your specific parameters would have to line up. You'd have to have the cash, you'd have to be in a certain tax bracket now versus a higher tax bracket in the future, right? So we use modeling and we use a lot of data to determine, when to do them and how much to do. But coming up with that perfect formula is almost near impossible because everybody's got a slight, unique, different circumstance.
Good point. Okay, will versus trust. What is the pecking order? I thought it was either or.
Two different documents, if you will, right? Assets that are in a will, you still have probate on them. A trust, really, the benefit of a trust is that you avoid probate, right? The courts don't need to get involved. Without knowing more about your specific situation, I could look at your overall situation and say, yeah, will be most likely sufficient. I could look at your situation and say, yeah, you need to have a trust. So it really depends on your assets.
Got it. And there's a question about financial advisors, certified financial planners. Yes, every advisor is a certified financial planner, which we are held to a higher fiduciary duty. You want to take on that just to explain it, Joey? Because he's also a CPA, so he's kind of double duty.
There's, we hold ourselves to a fiduciary standard. And to us, that means that we're going to give you the advice that's in your best interest, not ours, right? And we're not selling products and earning a commission or earning fees based off of products that we would recommend to you. That's not what we do. I think that working with the CFP is unique because it's a process. It's not a product, right? It's an ongoing iterative process where we're meeting throughout the year to monitor your net worth, your cash flow, your investments, your taxes, and wash, rinse, and repeat, right? It's not a one-time thing, if you will, meeting with the CFP. There's advisors out there, there's services out there where you can have an asset allocation strategy. You can meet once ever, and maybe that's for you. But for working, in my opinion, working with the CFP is an ongoing iterative process. And yeah, we hold ourselves to the highest standard to make sure we're giving you the best advice, not advice that's the best for us.
And then regarding a trust, if I have a TOD on my house, if I have basically transferred my asset, my house to my child, is that the same as being in a trust, or is that meaning that they are, do they get the step up in basis if they are TOD on my house deed?
So two different things going on there. Again, I don't want to get too much into the trust aspects. I'm not an attorney, but they would still get a step up in basis. But to determine whether the TOD and who it transfers to, we'd again want to take a look at those statements and see how the house is titled. But whether it's in a trust or held TOD, step up in basis should still apply.
And then if one has a trust and it's not contestable, does it still go to probate? And what does probate really mean?
So in general, trusts should avoid probate. Probate means that you have to go before a court, and a judge is essentially going to look at your will and pass the assets according to your wishes.
And it
Or
costs
if there
money
are no
because you
wishes,
need to have
they'll step in and they'll say, hey, this is what we're going to recommend.
correct. Um, okay, so are IULs viable options for someone that has just retired? They promise protection against market changes, safer than 401ks.
Yeah, so you're talking about the life insurance products. Again, it's person specific, right? It's person, but you have to look at what your future income is, what your future expenses are going to be. If you pass away, are you going to leave a spouse or kids with debt? There's just so many moving parts that have to be flushed out before I say, yeah, that's a great thing to do for a retiree or not.
Right. And then do you pay taxes on your home revenue based on regular income tax?
So based on, like, I'm assuming that's a rental
Well,
property, right? Or even
I
if
think
it's,
that actually, I think they're asking, am I paying ordinary income tax or am I paying long-term capital gains on my house? That's what I'm assuming
so
that means.
after you do get some expenses that get deducted if you're renting out a property or even renting out a room, but that whatever's taxed after your qualified rental expenses are deducted, it would be taxed at ordinary income tax rates.
But when you sell your house, it is taxed at long-term
Cap,
capital gains
yeah,
after
yeah, the
our
sale, yes, yeah.
exclusions. And we are getting a lot of very specific questions. Please reach out. We are offering you this free financial assessment to just talk to us, find out what we have to offer, if we can add value to your situation and what it might look like. You can speak to a financial advisor. As Joey said, everyone is a certified financial planner. We're held to a higher fiduciary duty. I hope you'll take advantage.
Thank you, everybody, for joining in. Thank you, Catherine. It's been a pleasure.
Thank you. Everyone have a wonderful day. We appreciate you.